Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Tuesday morning. We've got quite a bit lined up for the remainder of the week. Today at 10 a.m. we get the JOLTS number, and I would keep an eye on that JOLTS number, which is a job openings number. When we know we have non-farm payroll at the end of the week, we've got JOLTS today on Tuesday at 10 a.m. What that tells us is we know the FOMC on Wednesday is sort of bookended by two major jobs numbers, which, with all the attention paid on inflation, obviously that's something that we're looking at for the continued rate cuts that we are actually expecting. Let's go take a look at those expectations. But it's also important to remember that the Federal Reserve has a dual mandate, and that is they will be focusing on inflation while not trying to wreck jobs. So those numbers staying healthy so job openings staying healthy high, non-farm payroll staying healthy high. Those would actually be possible, up until recently, possible deterrents to the rate cuts. But now that September is fully discounted, and I mean fully, there's not even a little bit of a maybe they might hold. That's not even factored in. It's 91.6%. They're going to cut a quarter point. And then the spillover is going to the very, very slight chance that we end up with a cut in July and in September. But again, we're going to hold based on the data in July, meaning tomorrow's meeting is really about the statement, setting up September's cut, about the press conference, setting up September's cut, but it will be a hold tomorrow. All right, so with that being said, what the market knows right now, what it believes to be true, is that we're going to start on this rate cutting cycle that could take us into early summer of next year. And of course, this means every single month, it's going to be this kind of cycle of do jobs, do inflation, do all these metrics continue to point to each stepping stone, right, of continued rate cuts into next year, where the target rate probability is expected to fall from 5.25% to 5.5% down to as low as, and I'm talking probabilities here, not possibilities, probabilities of 3.75% to 4%. So that's a 1.5 point reduction in the rate that we're expecting between now and June 18 of 2025. So this is going to be a long cycle. At least that's what's being priced in by the Fed Fund futures, which is a futures contract like anything else, like gold, like S&P. Its job is to look at what the probability is of any kind of rate movement for each one of the meetings. So there's a futures contract for that, and that's exactly what we're looking at. So this is, as we like to endearingly call it, the macroeconomic decoder ring, because the only macro that matters is what the Federal Reserve is going to do next with rates, and this is how we map it. All right, so with that being said, if the market knows this is, I don't want to call it old data, but this is discounted data. We know it, we expect it, right? So now the equity markets have to find a reason, aside from that first rate cut, to continue higher. The month of July, most especially for the S&P and the NASDAQ, look very reminiscent of April of this year, right? That was the one, after 3 months of higher highs, we had that very wobbly April. Once again, after a surge in May, a surge in June, we get this kind of wobbly mid-July. So since OpX this month, July has been struggling to find the bid in the NASDAQ. But that's not the whole story, right? I know that we want to see tech move higher, and I know there's such a focus on the Magnificent Seven and earnings and whatnot. But the bottom line is the Dow and the Russell lagged the first half of the year, most definitely the first quarter, when the S&P and the NASDAQ were absolutely in fuego. So where the attention is for me right now is the Russell, right? So when we're asking ourselves the question of what's moving, right, let's not assume it's going to be what has been moving. What's moving now is really more in line with what's happening in the Russell, what's happening in regional banks, what's happening in the Dow, financials, industrials, healthcare, even transports. So it's just the narrative has shifted, right? Money doesn't go under the mattress. It's our job to find out where that attention, where that flow is going. All right. So the other thing too is I know we're in the middle of earnings season. So let me take a look at this calendar with you all before we jump into the questions. All right. So when we take a look here, this is a site called Estimize. This is what I use to track earnings. I'll tell you this really simply. Anything that's coming out this week in terms of a trade is just a non-starter for me. So I will tell you anything that's listed all the way to Exxon and Chevron on Friday, whether that be Intel, whether that be Amazon, whether that be Apple, Meta. This is a huge week, right? This is a huge week for obviously tech. So there's two things we have to remember. One, do I want to trade these events? Do I want to trade Microsoft into earnings? Not even a little bit. So this is where we have to remember, who's read the Mark Manson's book, The Art of Not Giving a Bleep, right? We have to stand guard at the gate of our mind and just simply accept, I don't care, even in the least bit, what's going to happen with Intel or Meta or Microsoft. I only care what happens after earnings. What's the response? And then do we start to see some strength? Do we start to see a bid? Because then that is going to move forward into strengthening the XLK, strengthening the NAS. So I'm only interested in what happens. I'm only interested in the result. I'm not interested in a trade. And I'm not going to guess either, right? If any of our trading relies on prediction, we're in big trouble. Because guess what? None of us can see the future. So what we want to remember is the best way to have expectations, because you might say, Ron, but we have to have an expectation. Yes, but we don't have to have it about Microsoft. We could try to go find something that's moving higher or is a relative outperformer and say, all right, let's see what happens after earning, after the dust settles, and then see what the net effect is to the XLK, to the XLC, to the XLY, to the NASDAQ, to semiconductors, et cetera. So this is where we have to be willing to just not care about certain events as a trade, but only certain events as clarity, right? Does earnings snap the NASDAQ out of this bearish chop that it's in? And this is as good a week as any to see that happen based on the data. So we could be interested in something, but we don't have to trade it, right? It may not be where the clarity is, but after earnings, we might get some clarity. So, think about whether the question, I think about this all the time. I ask myself, is the question that I'm asking predictive in nature, or is the question I'm asking about a setup, right? And it might sound like, well, aren't they sort of the same thing? No, because if I'm going to guess at which way Meta's going to go on earnings, that's a guess, right? I'm not going to do that, especially without a trend. And same would go for Intel or any number of these names on earnings. So I don't play earnings. I don't like them. It's a lot of needless volatility that we all have to deal with, but it might ultimately yield some clarity. And again, take a look at the list. It's a significant one. We got some healthcare by way of Merck and Pfizer today. Procter & Gamble, number one weighted stock in the XLP. So they're important, but they don't necessarily mean for me that there's going to be a trade. All right, so that's what we've got coming up this week. We've got JOLTS today at 10. We've got FOMC tomorrow at 2. We have non-farm payroll Friday at 8:30. And then some of the most important stocks, a number of the magnificent sevens. And why are they so magnificent? They're waiting in the S&P and NAS. And a lot of traders and investors wondering, all right, what happens next? And after we get this week, we'll probably get a lot of clarity into August with earnings in the rearview mirror, jobs data in the rearview mirror, the FOMC hopefully getting clear about setting up September. And then we can hopefully snap out of this weird little chop. Again, very reminiscent of April, where, by the way, remember, what was the result of April? We resumed the uptrend. So as long as this is chop, it doesn't get any traction to the downside in terms of a downtrend, which on the NAS or the S&P, it has not yet for me. I'm going to presume what I always presume within the context of stepping back and looking at the trend for the year. I'm going to be looking for continuation. All right. So there's the breakdown of what I'll be looking at here. So let's go ahead and take a look at some questions. Let's see here. Joe asks, all right, bullish or bearish? Yep. Joe, so Joe, there's your answer. I'm not either, right? Because that's predictive. So let someone else build some sort of spread around that and take a scratch off lottery ticket guess. It's not going to be this girl. Yes. So I will not be trading these this week. There's better clarity leading up into earnings in the preceding weeks, not the preceding days. And that if you and just don't take my word for it, gang. Step back and look at trending stocks 6 weeks, 4 weeks, and 2 weeks out from earnings, and you'll see the much more predictable. I hate that word, right? You'll see the much more probable move, right? Because we're all looking at prediction, but I think that's a very difficult thing to optimize, right? You can't predict anything. However, if something's moving higher in front of earnings, I'll continue to take advantage of that up until about 24 to 48 hours before the release. And then I'll wait about one session after the release to let the dust settle. All right. So next question. Do I use historic rate cutting cycles after long bull runs as a guide, or do I not use that information to assess probable outcomes? I know there's a lot of, the only thing that I use from a historical basis is volatility. Other than that, remember, each rate cutting cycle has its own narrative, but it has the same result. Leading up into rate cuts, once we know they're happening, right? Once we know they're happening, that's a really important distinction. Once we know they're happening is seldom bearish. Now, some people might say, but Rag, a lot of times we have a lot of weakness into rate cuts. And we could cite 2020, or that's not really a great example, right? So I want to look at the circumstances of the current cycle, because they're all going to be different, right? The circumstances in the anticipation of the current rate cutting cycle is the S&P and the NAS up until mid-July were bumping up against and exceeding higher highs, all-time highs, right? So I think it's very difficult to say, well, back in this year, this happened. Back in this year, that happened, because the circumstances leading up into each one was so dramatically different. So the simple answer is no. I want to look at the narrative that's happening now, the trends that are happening now, and no. So I typically don't. I mean, we're aware of them. That's an easy thing to look back on. Heck, you can ask ChatGPT, right? That's really easy. It's kind of fun to do that. I spend a lot of time on the weekends prompting ChatGPT for different scenarios, which is, I don't know. That's my idea of fun. It tells you a lot about me, but I will not do that as a general rule. But thank you for the question. All right, let's see. I have a question about risk management. If a person is in a position where they are green, but within the implied earnings move, is it recommended for that person to get out of the position? Or implied volatility going into earnings is not ever going to be my target. No, we want to be aware of that, but that's not enough information to give you a risk management answer by my metrics, Joe. So the bottom line is, what was your cost basis? What's your target? If implied earnings, the implied volatility into earnings is part of the target, which is not for me. But if it was, then I would look back on your original trading plan. But I don't use those metrics. I don't have hundreds, if not thousands of trades and data over years for that. So I really couldn't answer based on what you've given me there. But I will tell you the same thing. What was your stop loss going into the trade? What was your target? And both those things have to be known at the time of the entry, right? That's the full architecture of the trade. That's the full blueprint. And then if you are not quite to the target, but earnings are coming up and you want to step out before the chaos ensues, before the uncertainty hits, for me, there's always the choice of a time-based exit. So that's kind of the best answer I can give you, Joe. There's that time-based exit of, I don't really want to be subjected to the potential, for example, Microsoft, volatility of Microsoft. So if you, for example, got in, I don't know where you would have gotten in, but let's say we're taking a look at Microsoft and someone said, Rag, I know you don't like red candles in a gray area, but we had support there around 418 to 420. Here I am knocking on the door of, you can see over here, we're knocking on the door of what? Where are we right now on Microsoft? Let's take a peek. Yeah, 427, 430. Maybe your target was 435, but we're not quite there. Don't ever hesitate to say this is a win, and then there's an economic event on the horizon that could undo this. Sure, it could send it higher, they could also send it lower. So I love that you're geared towards risk management. And to me, hitting the eject button, the time-based exit, can be a very effective thing. Yeah. All right. So let's see. Bank of America. Yeah, Ren, I've had my eye on a number of financials. So let's talk about Bank of America. Yeah. So JP Morgan, Citi, Wells, Goldman, I think American Express, and Bank of America were all last week really good looking names. Bank of America is hitting quite a bit of selling. There's clearly an individual narrative affecting Bank of America. There's obviously some selling going on that's out of sync with XLF. So I've got to abandon Bank of America at this point. This was a good looking name for me. And then the selling has hit it. That's moving against a lot of the strength in financials and Dow. This is how you know something is hitting a single stock in a way that's not affecting the other group names in the group, is when, for example, JP Morgan is still moving higher, or Wells is still moving higher, and Bank of America is moving lower, while the Dow and financials, XLF, are moving higher. Those are things that are then at that point misaligned. And Bank of America right now is just struggling. So I'm going to leave that alone. And every single day, I will have fresh eyes and say, okay, this is what I thought on Wednesday, and I might be right or wrong. This is what I thought on Thursday. Has anything changed since then to alter my opinion? Yeah, JP Morgan would look like a better stock for me now on a Tuesday as opposed to, say, last Tuesday. That's the difference of, what's that saying? Strong opinions held loosely. I always reserve the right to say, you know what? The structure has changed, and I've got to change, therefore, my trading plan or my priority for that symbol. So, what I do is just say, if I'm in that trade and it's exceeded the allowable risk to the premium paid and the account, I get out, right? Now, I'll tell you what most traders do. They'll add, they'll reduce the cost basis, they'll roll. And those are very dangerous things to do, because what happens is, once you go beyond fixed bet sizing, once you go beyond what the allowable amount of risk to the account and the allowable dollars allocated to the trade are, what happens is you might say, well, I lost on that, but it's a bigger loss than some of the wins that were not added to. So add is a 4-letter word in our room. We don't do it. We don't do it. It's just it's a very cute little dinghy that takes you down the river of denial. So Bank of America, I had to cut straight up. I'd rather take a small loss than a large one. And we all have a too big to fail line. All of us do, right? Oh, this position's too big. I got to keep adding to it, because if I actually eventually realize a loss, it's a large hit to the account. And those are things that just aren't talked about when people just continue to add to losers. Now, and that's, by the way, what it is, right? So I think ultimately adding is a very dangerous and unscalable approach, because here's the thing. You might say, but Rog, eventually Bank of America might bounce. Yes. But remember, when we play options, which I would imagine most of us do, when we play options, what happens is, this isn't a share. I can't hang on to this till the end of time. The challenge is this. At some point, that option is going to start to experience time decay and will expire. So there is an end date. So now we're playing a race against adding, hoping it bounces by lowering our cost basis before expiration and time decay. And that is a race at scale. I don't think we win. We might win every now and again, right? But I think at scale, it's a terrible habit. And we just simply don't do it. So Bank of America, just didn't do what I wanted it to do. I know my fixed risk, and I get out of the trade, because small losses are psychologically and financially easier to recover from larger ones. Larger ones are very difficult, very difficult. It's the difference between wrecking your car or really doing some damage and just getting a scratch. I'd rather just get scratches. That's what we call them, paper cuts in the room. All right. So short term, I'm going to leave. Now, if I were to say, what do I want to do with Bank of America today, Eddie? It might be a 5-minute chart. It might be a 1-hour chart where the time horizon is really small, and I might be bearish, but we'll see what happens with the Dow. We'll see what happens with financials. And the bottom line is, Bank of America for me isn't the stock that I liked last week. So again, strong opinions held loosely. We're always building and then rebuilding adding and eliminating things from our watch list. And that takes a lot of discipline to say, hey, let's just cut this one loose and focus elsewhere. Right. And I'll tell you straight up, our focus right now is staples, things like Coke, things like utilities, regional banks, the Russell. And that's where our focus is right now. And notice again, kind of going back to that earnings question, none of it is geared towards my trade being right or wrong based on any of the earnings this week. All right, gang. As always, thank you so much for being a part of Charts and Coffee. Thank you for your questions. And I'll see you tomorrow. Same time, same station. Be good to each other, gang.